Okay, welcome to today's presentation and Q&A with NB Private Equity Partners. We have Luke Mason from the managers with us today. Before we get going on the presentation, I'd like to highlight there will be a Q&A at the end of the presentation. Please do submit questions in the box at the bottom right-hand corner of the screen. I can then address them to Luke and try and bring them all together and make sense of them. There'll be a recording of this presentation available online shortly after it finishes, as is the case for last week's roundtable webinar, which Luke and managers of two other private equity trusts discussed the prospects of a recovery in private equity NAVs and share prices. So without further ado, I will hand over to Luke. Thank you, Luke.
Brilliant. Thank you, Billy, and thank you all for joining. Good afternoon. For those of you who haven't met, my name is Luke Mason. I'm part of the private equity team at Neuberger Berman, based here in London. What I look to do over the next 20-25 minutes is just give you a brief overview of NB Private Equity Partners for those of you who aren't aware of us and the strategy and the trust. Talk a little bit about why private equity, the opportunity set we see today, before walking through the strategy in a bit more detail, looking at the current portfolio, the outlook, but also looking at the capital allocation framework and policy that we've put in place. So maybe flicking on to the first slide, just a bit of an overview of NB Private Equity Partners. As a reminder, NBPE invests in private companies to generate long-term growth. It does this through co-investment, leveraging the strength of NB's private markets platform, investing alongside lead private equity managers directly into companies. We don't do this through funds. I'll go through some of the nuances, the benefits of the co-investment model in a little bit more detail, but I think it's important to highlight, to start, for those who are not aware of us, how we are. NBP, we believe, is differentiated from others in the listed private equity sector, as we solely focused on co-investment as the main way of accessing private equity companies. As you can see on the bottom of the slide, some of the benefits we think of the model is that we believe it's the best of both worlds. You get direct exposure to individual private companies, but also the diversification across top-tier private equity managers. In terms of control, we control the investment decision. We are able to build a portfolio investment by investment from the bottom up. We can start and stop investing when we like, and be highly selective when it comes to making investments. In terms of flexibility, we have a robust capital structure, which I'll talk about in a little bit more detail, and we believe is inherently lower risk than potentially some others. And it's very fee efficient. So we pay no fees and no performance fees to the underlying private equity managers when we invest directly into these companies. And on the right hand side of the page, just looks at the portfolio. The portfolio has generated some strong realized outcomes on direct equity investments over the last 5 years. And actually, if you look at over the longer term, over 10 years, NBP's share price total return is about 235%, and we've generated about 10% plus NAV growth over that period, as annualized over that period as well. So maybe just taking a step back before diving into the strategy, and I'll just talk a little bit more about why private equity. As many of you know, private equity comes in many forms, but at its core is investment direct into private companies for the long term, creating value through active ownership and operational improvement. In NBPE's case, we are primarily focused on investing through buyout, and actually in the mid-market, backing established, profitable and growing businesses with proven business models and cash flows, rather than early stage or venture companies where, from our perspective, the path to profitability and growth is more uncertain. Across our platform, we do invest in venture and growth equity, but very much not in this portfolio itself. NBP focuses on two key themes: looking for businesses with low expected cyclicality and long-term secular growth. And we have deliberately tilted the portfolio to focus on companies where sales and profits are not wildly or do not wildly swing with every macro headline, and which operate in markets that are steadily growing and getting bigger over time through technology adoption, demographics, or regulation. And on the next page, you can see, in my mind, so one of the real benefits or key benefits of investing in private equity is the sheer size of the private equity universe and the opportunity set. On the left-hand side of this chart, the chart shows the increased number of private equity-owned companies in the US mid-market compared to public companies. As you can see, actually public companies from 2000 to 2005 have actually fallen from about 8,000 down to just above 5,000, whereas actually privately owned businesses have materially increased. On the right-hand side, it shows the growth in the mid-market in PE-backed companies since 2000 versus listed business, both in the US and in Europe. And as you can see, in the US particularly, only 1% of the companies are public, whereas in Europe, 96% of companies with revenues over $100 million are private. So in our minds, by accessing this universe, investors can diversify beyond the relatively small number of listed names and also capture some of the growth opportunity that occurs. On the next slide, we can just show private equity is now a mature, established asset class, which is predicted to grow. The chart on the right shows by single-digit CAGR, high single-digit CAGRs moving forward according to Preqin. And it has always attracted significant inflows from institutional investors, which seek returns above public markets. And actually, the first bullet highlights over the longer term, private equity has outperformed public equities. Clearly, and it says global private equity buyouts has outperformed versus the MSCI over 20 years by about 400 basis points annualized. But also what we're seeing over the last number of years is actually the growth in high net worth and wealth clients coming into private markets as a result of regulatory reform and subsequent product innovation. And I think that's really quite interesting. And to caveat this, I appreciate despite kind of returns being more challenged because of the macro environment in more recent years, actually underlying portfolio companies have continued to grow strongly. And I'll show, I'll look at NBP's portfolio in a bit more detail in due course, continue to grow earnings and cash flows quite steadily over time. So in my mind, actually the ability to invest in listed private equity to get access to this exciting segment of the market is very interesting, particularly at this moment. And I'll talk about that more in a little bit more detail. So maybe just wrapping this up, in my mind, 3 potential benefits of private equity exposure. The first is diversification. Companies are staying private for longer, and there is a large addressable universe where returns are driven by company fundamentals more than the daily market flows or public markets. The second is the value creation piece. Active ownership and taking a long-term perspective can create real value that is harder to replicate in the public markets. And the third point I think I want to highlight is just the potential for attractive risk-adjusted returns over the long term, particularly for patient investors. So maybe just changing gears slightly, just looking for those who are unaware, we'll just look very briefly at MB's private markets platform and before going on to look at co-investment and the benefits of that model. So for those of you who don't know us particularly well, so Neuberger is an independent employee-owned global asset manager. We're managing about $600 or $558 billion across equities, fixed income, and alternatives. Within alternatives, we're managing about $150 billion across our private markets platform. And as you can see on this slide, we've got a very large, experienced global team. It's incredibly stable. There's 98% retention of senior leaders in the investment team. The joke is we occasionally let people retire. But I think what really the way we position the platform is that we're a capital solution provider for private equity managers. And what I mean by that is over the last 35 years, we look to partner with leading private equity managers and support them across investing in their funds and their strategy they run, but also supporting them across the capital structures of their underlying companies. And I'll go into a little bit more detail of that in a little bit in due course. I think because of our position as a liquidity provider, actually, it's been really interesting. As you can see, in terms of the market opportunity, the global buyout fund deal flow has actually declined over the last 5 years since 2021. However, MB's private markets deal flow has actually increased by about 51%. I think that is due to our position as a solution provider and a partner to private equity managers. And I'll come on to talk about some of the reasons for that again when we talk about differences or nuances in terms of co-investment. Just again, to put this into context, so last year, for example, we were reviewing about 12 co-investment deals a week, which has grown from about 8 deals in 2021, so a significant increase. But crucially, we're only doing about 10% of those deals, and which is we're very selective in terms of the transactions we look to do, both across our platform and also across investments into MBPE. So maybe just looking at our co-investment approach and why we like the co-investment model. So MB's co-investment model combines, as mentioned, the benefits of direct investment with diversification across private equity manager, sector, and also company size. As you can see on the top, kind of three key points that I wanted to kind of highlight. I've already talked about the fee efficiency point. So we pay no fees and no carry to the underlying private equity managers when we invest directly into a company. Capital efficiency is really important. Our ability to build a portfolio investment by investment from the bottom up, be very selective in terms of the deals we make. We can start and stop investing when we like. And actually, we've actually reduced the amount of exposure we have had over the last number of years because of the less visibility in terms of the realization environment, and the board are very much focused on balance sheet strength, which I'll talk around in a little bit more detail. We don't have huge unfunded commitments like a fund of funds, for example. So actually, and as you see, the benefit of a co-investment is we make a single ticket investment directly into a specific company, and we don't go through a fund. And the last thing on the right-hand side, the last box, is in our minds, the buyout return. We feel we have attractive risk return profile, buyout returns with lower risk given the greater diversification, and also the dual due diligence that we perform on every investment. We not only due diligence the private equity manager or sponsor, we also do our own due diligence on the company. And crucially, we work out whether the company and the sponsor actually fit together. Because you could have the best private equity manager and a very good company, but actually in a sector or an area that they haven't had experience or exposure in, and therefore, from our perspective, that's the determination of this consideration we have to make. In terms of the next slide, it just looks at the co-investments. There are effectively three different types of co-investments, and traditional co-underwrite and midlife. You're pleased to know I'm not going to go through each in detail, but I think the pie chart on the left is very interesting. Just seeing the shift in terms of co-investment deal flow across our private markets platform, and 83% of the investments we're doing at the moment are in midlife and co-underwrite transactions. And very simply, a co-underwrite is before a deal is signed, the private equity manager will call us up and approach us and say, look, we want you to come in and help support us in this specific transaction. So our capital is crucial to actually make that transaction complete. As in return, we get greater exposure or access to due diligence materials, structuring and the execution of the transaction, and can work hand in hand with the private equity sponsor and lead manager. And one of the main reasons that private equity managers like using someone like us is that we can add a bit more value because we're invested in, say, across our platform, 900 plus private equity funds. So actually our market visibility and knowledge is very, very broad, and we can bring and add value and advice and thoughts to a particular deal or transaction that the sponsor might not have. Midlife are very interesting. With traditional and co-underwrite, the first two, we are being reactive. The private equity manager is picking up the phone and calling us and saying, here's a transaction, here's a deal. In a midlife deal, we are sourcing those transactions ourselves. So we are proactively calling private equity managers that we have relationship with and targeting their best companies, going, we really like this business. Can we help support you? Do you need any extra equity to continue your value creation plan, whether that's an M&A or an add-on acquisition transaction? Do you need to recapitalize, or are you going to be under pressure for your underlying investors, and do they need to divest, and can we help support you and come in and get exposure to this company? And I think it's really interesting. A midlife deal, as the name suggests, is where we are coming in midlife. So a private equity manager has already held an asset for a number of years. The reason why we like that is that we are able, it's a less competitive process because we're the ones coming up with the transaction. The second, from a valuation perspective, again, we are determining the price, but obviously there's a dialogue between the private equity manager and ourselves. There is potential for earlier monetization as well. So a traditional co-investment, typical hold period is 5 years, 5 to 7 years ultimately. Whereas actually in a midlife, because we're coming in later, there is potential for us to exit earlier, say a 3 to 4 year hold, for example. And finally, the benefit of a midlife transaction is about risk mitigation. Because a private equity manager has held the asset already for a number of years, they are already putting in their value creation plan. We can see how that company has performed under their ownership. Crucially, as many of you are aware, like buying a house, when you buy a house or when you invest in a company, you don't truly know. You can do all the due diligence and work until you get through the door or till you're given the keys and get to access it. You don't truly know exactly how it operates. And so actually the ability to kind of de-risk that by going into a company that a private equity manager has owned a little bit longer is really powerful. And a great example of this, a midlife transaction we did more recently in MBPE, is in Infogroup. Infogroup operates as an integrated infrastructure service provider across several European markets, Belgium, Germany, the Netherlands, and France. It had expertise across electricity and gas, water and sewage, telecoms, data centers, and roadworks, for example. The investment thesis is very simple. It's underpinned by the long-term infrastructure spending needs and visible demand for infrastructure. And we see multiple value levers for value creation, including one, organic growth, but also operational efficiencies and targeted M&A. And just to give you an example, PAI, who we partnered with in September 2025 on this transaction, since they invested or became the majority owner of the company in 2023, have completed 27 add-on acquisitions to this business. So maybe I will just move on to look at NBP in terms of portfolio, just to give you a bit of an overview and a flavour for how we're positioned today. So turning to the funds, we're about 1.2 billion in terms of the value of the direct portfolio, 68 positions across 45 different private equity sponsors. In terms of fair value, about 94% of the top 50 investments. And actually, if you look at the top 10, it's about 42% in the top 10. The other number I think is really important to highlight is the average holding period, the average years. So it's 5.8 years. So in my mind, as we see the exit market improving, and I'll come and talk about that in a little bit more detail, we think we have a very high quality portfolio that is exit ready. And we had good visibility of potential exits in the portfolio the next 6, 12, 18, and 24 months. Just looking at diversification, as highlighted before, this is very much built investment by investment from the bottom up. We're not trying to target specific sectors or geographies. Predominantly, actually, from a geographical diversification perspective, we're predominantly investing in the US with an allocation to Europe. Sectorally, as I said, diversified across sector with tech, media and telecoms, consumer and e-commerce, and industrial technology being our largest sectors. And obviously, we are diversified by vintage year as well. And I think it's important to highlight that we don't want one portfolio position to dominate and drive returns both positively or negatively. So actually, the ability to design a portfolio to mitigate idiosyncratic risks while still allowing winners to drive performance is very important to us. So maybe just looking at the top 10, first, I think, as mentioned, 42% of NAV. So relatively concentrated group of high conviction positions, which have grown and performed very well. I think the key things to highlight from my perspective, just when we look at the top 10, is that the way value is being created in these businesses today is very much skill-based rather than market-based. And what I mean by this is that we are backing high-quality private equity sponsors who can really drive operational improvement, pricing, and M&A is a great tool and way that they're doing this. And so what we do is we lean into partnering with sponsors who are sector specialists and have proven value creation playbook. Something we like a lot is add-on acquisitions or M&A, because M&A, if it's done well, can bring great synergies and broaden the product range and also geography, and compound value without relying solely, say, on the market to increase the size of the company. And actually, if you look at one of our top holdings, Osaic, which is in the middle of this chart, is a large US wealth management platform. It benefits from real scale, in the independent advisory channel, and has delivered strong organic growth helped by continued advisor recruitment, so buying small advisory firms and deepening relationships with existing advisors. Actually, Osaic's a great example as well. It's also been a source of liquidity for the trust. Last year, we had a partial realization of Osaic at an uplift to carrying value, and the remaining stake has continued to appreciate. So it's contributed both realized and unrealized value. Action is our largest holding. I'm not going into detail about Action. Many of you know Action incredibly well. We still believe the company continues to perform incredibly well. Has a great pace of store rollouts across Europe, great like-for-like sales performance with a very disciplined execution. Interestingly, actually, we've taken money off the table twice in Action, and we had the ability to do that earlier this year and also a couple of years ago. That was very much from a portfolio construction perspective, rather than because we didn't believe in the fundamental future of the business. And it's very much so trying to say, as I mentioned before, not have one position kind of dictating the size. But it's a very nice place to be in, as our largest holding has been performing very well. So maybe moving on just to look at the underlying operating performance of the portfolio. And despite a more challenging period for realizations, our portfolio companies have continued to perform well. On a look-through basis, the weighted average EBITDA revenue, LTM revenue and EBITDA growth has been 9% across both. And actually, our top 10 has performed a bit more, has performed well, growing strongly at about 14% and 60% on a revenue and EBITDA basis as well. So the engine room of the portfolio continues to drive performance. As of the interim results or interim reports, the portfolio is valued about 15.4 times. You can see it on this slide, versus roughly 18 times the S&P on a similar basis. So actually, we're not claiming the portfolio is cheap, but it's not richly priced relative to public markets. And particularly when you consider the profile of the businesses, often sector-leading companies in healthcare, business services, software, growing their revenues, low double digits year on year, plus the trust is currently trading at 25% discount, we think is a potentially interesting entry opportunity. So maybe shifting gears slightly, and I'll move on to this slide before coming back. So, I think we've talked a lot, and many people have talked about the realization environment. And I think this chart actually shows it quite nicely in the fact that this chart shows the buyout fund distributions as a percentage of beginning of year NAV. And clearly, as you can see from 2023, there has been a bit of an uptick in momentum, which is built through 2024 and into last year. And 2025, from our perspective, was pretty U-shaped. You had a very good Q1. Q2, the brakes were put on realizations because of Liberation Day. Q3 was a bit more, again, things were a bit slower to start, but actually Q4 was very strong. And I think we saw this across MBP's portfolio. And actually, taking a step back, 25, despite that kind of Q1 and Q4 being kind of the bookends, was actually the second highest year for realizations behind 2021, despite what we saw. And actually, that momentum has continued into this year, which is superb. And actually, just looking at MBP's portfolio as a whole, as you can see, last year we saw $180 million of realizations from both full and partial exits at an uplift of about 17% to carrying value. And the interesting thing is, if you look in great detail, and apologies for the slide being a bit small, but the percentage of co-investment exits was actually an increase of about 50% compared to 2024 in non-core positions. I think is the other thing to highlight. So it wasn't actually our largest companies that exited, it was other portfolios or companies within the portfolio. So maybe I'll just touch on liquidity and capital allocation, because hopefully this brings it a bit more to life in terms of what I was talking about in terms of the focus on balance sheet strength. So many of you know we have a very simple capital allocation framework at MBP. It's made up of two pillars. The first pillar is allocating capital to new investments, the principal use of capital to drive NAV growth. And the second pillar is about returning capital to shareholders through dividends and through buybacks. And given MBP's co-investment model, the board have prioritized balance sheet strength in recent years. And what I mean by this is actually we've de-geared the strategy from 2021 to today being about only 1% levered. So we have 1% leverage within the fund, and to have about $302 million, as you can see on this page, of available liquidity. Typically, we want to target between about 105 to 110% invested. And this is very different from many other peers in the fact that we don't have huge amount of unfunded commitments or are highly levered on the underlying underneath the investment company structure. So because of this, and given the greater visibility in terms of realizations, the board decided, greater visibility in realizations and the strength of the balance sheet, the board announced an intention to increase the allocation to new investments over the next 3 to 6 months. I think this then obviously ties into the second pillar of our capital allocation framework, which is returning capital to shareholders through share buybacks and through dividends. And many of you might have seen that in February last year, the board announced an increase in capital reserve for share buybacks with 120 million allocated to over the next 3 years. In November last year, as part of the update in terms of putting more money to work in terms of the investment program, the board highlighted that the $120 million allocated could be used up sooner if existing conditions persisted. And actually, that's what you've seen in 2025 and through to the 20th of January. So last week, MBP has approximately bought back 302 million shares, approximately about $64 million at a weighted average discount of 26%, resulting in a NAV appreciation of approximately 52 cents per share. The second part of the returning capital to shareholders is the dividend policy. And including the H1 dividend, which we announced recently, MBP has returned or declared approximately $550 million to investors by way of dividends and share buybacks. 420 million of that is through the dividend, which we introduced in 2013. And as you can see, just looking at the bottom of this page, you can see in terms of distribution to shareholders last year, nearly just over $100 million was returned through buybacks and through dividends because of where the trust was trading in terms of the discount. So maybe I will, conscious of time, maybe I will just conclude by, and I won't go through this slide in detail. I think hopefully what I've tried to highlight is that I think we're positioned to give long-term shareholder value. We have a high quality portfolio with strong underlying operating performance, particularly amongst our largest holdings. We are well positioned in the improving exit market with mature portfolio and a number of exit ready companies. And you already saw that last year in terms of $180 million of proceeds that we received. The balance sheet is very strong, providing flexibility to both increase investment activity, but at the same time, return capital to shareholders through the dividend and through buybacks. And in my mind, we wouldn't be able to put more money to work if we didn't have the deal flow from the Neuberger Berman platform. And I'm really excited about some of these midlife co-investments, which I talked about briefly, which we're able to source, which give us exposure to companies already in their value creation phase. So I appreciate I've whizzed through a lot. Billy, I'll hand over to you. If there are any questions, very happy to take them.
Absolutely. We've got a few in the hopper. But if you would like to ask a question, there's a box on the right-hand side, a sort of round circle with a square and then a question mark in it. You click on that, then you can type in your question. One question. What is your failure rate? By which I mean those companies that have either failed to reach your expectations or have failed entirely. I suppose it's probably two different questions.
We don't have specific details of the failure rate for the portfolio as a whole, but crucially, companies do perform differently, I suppose, over time. I think it's good to look at the long-term track record of the trust. And actually, if you look at the first slide, I think, or actually, if you just look at the realizations in terms of companies that were exited last year, of about a 70% uplift, but also about 2.7 times our money in terms of the amount of money we invested. As mentioned, there are certain situations and circumstances when companies don't perform as well, but actually the benefit of being privately owned is that actually private equity managers can take a longer term view and change their thesis or change the way they're looking to invest or adapt. And actually something we saw very crucially was actually the ability for private equity managers to pivot and in the face of tariffs, greater geopolitical uncertainty, to shift business models, and also in COVID. So actually the ability to be more nimble than potentially some private markets peers. So not all companies go exactly to plan, but actually the consistency of returns has been very good over the longer term for MVP and for MB as a platform more broadly.
Fantastic, thank you. A couple of questions on discounts, and I guess I'll try and group them all together. But broadly, obviously the whole sector has quite wide discounts. Do you have a view on the wide discount of your own trust? Do you have what's the board thinking about the discount in particular in the background of other trusts having quite wide discounts?
Yeah, I think it's a great question, something that the board consider and we consider as manager a lot. I think, as highlighted, there is no silver bullet to reducing the discount of the sector as a whole. I think there are many ways. One is the investment performance. Two is the return of capital through the accretion of the NAV by using buybacks. And actually, you've got to use, as you say, we have two pillars for our capital allocation framework in very, very distinctly, or the reason we have two pillars is that investment performance plus returning of capital is the way that we believe we're going to reduce the discount over time. Crucially as well, it's about educating and people understanding the asset class. I fully appreciate it's been a more challenging period for private equity returns over the last couple of years. If you look at global buyout funds, NAVs are only annualized about 4% over the last 3 years in terms of return. That's a long way from the long-term kind of NAV growth I highlighted at the beginning of the trust as a whole. So, but I do think, I think broadly as a sector, there's some very high quality managers managing very good businesses. And I do think as we see realizations improved and pick up, we'll hopefully see the ability to reinvest into new investments, and hopefully discounts will narrow in due course as performance naturally improves. But yeah, I think the highlight is we're saying there's no one silver bullet. We think actually that, you know, but also maybe some controversy to some individuals, like even if you say, if the discount remains stable and you still are able to get share price and NAV appreciation over time, from a shareholder total return perspective, that is okay as well. The one thing that shareholders do not want is volatility of discount and volatility of share prices and NAVs, if you will. So in my mind, no silver bullet, and the board are very much in the same mind. But actually, they are pulling the multiple levers you can pull to try and narrow the discount.
Fantastic, thank you. And obviously, NB are a US manager. Decent chunk of the investments are invested in the US, and the US is generally a leading indicator. Hopefully, not necessarily about politics, but you know, are there any trends out in the US that NB is sort of benefiting from that maybe European private equity managers will be following soon?
It's a great question. I think from our perspective, you know, we very much, and of the, I mentioned briefly, but we very much focus on mid-market, domestically focused companies. And actually, a lot of our exposure is to the US domestic economy, and actually it's still performing incredibly well. I think one trend we are seeing, and this is obviously a buzzword everyone is using, is the adoption of AI. But I'm not talking about investing in the OpenAIs, the Anthropics of this world. It's very much the adoption of AI at in order to create operational efficiencies and margin improvements at the underlying company level. And actually, private equity managers are doing this globally. So I'm not saying it's specific to the US versus Europe, but actually, I think what we are seeing is that adoption of using AI as a tool to create value within companies. And actually, we're doing it ourselves as a private equity manager, but also as a provider of capital. We're using tools to make processes more efficient. So I think from our perspective, potentially private equity managers are able versus public markets to implement tools more efficiently in the shorter term than public markets, for example, but that will catch up. So AI is an interesting tool. A lot of talk about AI, particularly but actually we're seeing it as a really interesting, from the operational side, that making companies more efficient. And I'm not just saying it's one thing, US versus non-US. I think the only other thing I'd say is what we would like to see is stability, both on the macroeconomic and geopolitical side, but also stability more broadly in terms of markets. I'm not saying, you know, we don't need, private equity doesn't need an environment. We don't need the IPO market to go on a massive run. M&A, that will be positive in just terms of sentiment, but actually stability is important more broadly across both public and private markets. So I think that's key in both in the US and across Europe as well.
Fantastic. And actually, the slide you got here refers to uplifts of 32.3% on a full or partial realization over the last 5 years.
Yes.
You know, valuation, so discounts are wide, but the NAV is based on obviously valuations that A, historic, and B, when you sell investments, they tend to, well, by that stat, it seems to be on a premium. So the question is, I suppose, how sure are you of the NAV, and what's the process in which the NAV gets updated?
Yeah, so in terms of the NAV, so we take NAV is updated on a quarterly basis. We receive marks from the private equity sponsors that we are invested alongside. We obviously look at them, we do our own analysis of where companies are marked. Clearly as well, one of the benefits of the independent board of directors and the investment company structure is the board themselves do an independent analysis of where the valuations of underlying portfolio companies. It's a bit easier for us, I suppose. One of the benefits of the direct model is we have 68 holdings across 48 managers. So actually our ability to go line by line and look at individual companies and how they're positioned and how they're being valued. And, you know, we can, and we sometimes do, you know, ask additional questions to our underlying managers in terms of what if there is a big shift or a big move. I think from our perspective, you mentioned, you know, the uplift number, the average over the last 5 years. I think you probably saw, as I mentioned, you know, the realizations last year were at a 17% to uplift to NAV or to the value 3 quarters prior. And so actually what we're seeing is value uplifts on exit are actually probably reducing and will reduce over time. Hopefully we're still going to get high double digits in terms of realizations, or in terms of uplift, sorry. But actually I think there is just the way that the private equity market is evolving. with the growth in other structures, whether that's evergreen funds, we'll likely see NAVs grow more consistently over time, rather than historically what private equity managers have been criticized for, is holding NAVs flat and then having massive pops on exit. So I think there'll be more consistency in terms of the way that companies are valued, and we're seeing that already across the piece. So from our perspective, benefit of the end of one is from our ability to look line by line in terms of the portfolio. Two is we do our own analysis in terms of the marks we're getting from private equity managers, and hopefully the third level of support for investors within NBP is that the board do twice yearly obviously their own independent analysis of the portfolio in detail, both the interims and the annual report.
Fantastic, Luke. One last question, has anyone else got another one? What is the process for assigning the personnel to run companies, presumably private equity backed companies? And does this depend on who's co-investing, and what's the process for detecting whether management or management approach needs to change?
It's a great question. So what ultimately happens, it's the private equity sponsor or manager who determine the direction of travel they want to take a business in. So they will look at the existing management team, they'll work out their playbook in terms of the value creation drivers they want to do. Some people like stability in terms of value, and when they initially buy a business, looking at the management team in terms of stability to ensure they come in, they're able to do kind of their underlying analysis of the company. As I mentioned, like buying a house, you don't truly know what a business is like until you truly get through the door and are able to kind of go into each room and knock on a couple of walls and check there's not mold in certain areas. So what we typically see is part of kind of the private equity manager's playbook in terms of, if they feel there needs to be a change at the management level, they will then enact that as part of their broader value creation plan. But it's very much sponsors decide who they want to bring in. Typically, what they have is they have a list of whether that's directors or chair people, that they have a playbook of people they typically have done this before in that specific sector or that specific type of company. And so sometimes they bring in people who are very knowledgeable about that sector and how to run these businesses as well. But it could be that the private equity manager really likes the management team, they're very aligned, they're very supportive, and it's just helping them facilitate the plan that they have in place. So it really depends company by company, sector by sector. So there's not one specific model, but yeah, ultimately the private equity manager, the majority owner of the company, determines the strategy of that business moving forward.
Thanks, Luke. A couple of quick fire questions come in, which I think we've just got just about time for. Obviously, private equity is the sort of almost epitome of active management, but there's a question of is there an index or an ETF that would be useful to track private equity companies' valuations?
Is there an ETF? There are a number of different products you can that track listed private equity vehicles. There are a number of very large listed alternative managers that people can do to track. It's very difficult to track individual company valuations, but you can get a general trend of how market is doing in terms of fundraising and or performance. There are some the different nuances of the listed investment company structure. There are different types of vehicles that you can have. You can have some of the fund of funds with a couple of thousand underlying positions are more of an index tracking private equity benchmark style return. Whereas I mentioned the co-investment model, we're getting a bit more focused in terms of our approach in terms of individual companies alongside managers and sponsors. And then you've got obviously the direct managers, where that's sector specific managers at the other end. So different ways of playing it. In terms of underlying valuations of companies, no, I don't believe there is a one single ETF that will track that. But if people want broader private markets exposure, there are certain aspects or certain products that will do that.
Thank you, Luke. Lastly, can you tell us about the board and managers' skin in the game?
Yes, both the board and all members of the board and members of the manager do have skin in the game per se, in terms of both purchasing of shares, but also from a manager's perspective, investments in or allocation in terms of our compensation to the underlying deals, so we're aligned in terms of the individual deals in the portfolio in terms of the way that we're remunerated as well. So yeah, we are. There is alignment there, and that's very important to us as both manager, and also you can go and see the board's allocation to shares, but all members of the board have exposure to the company.
Fantastic. So there don't seem to be any more questions, and I think we're pretty much up for time. So I'd first of all thank you all for dialing in and listening over your lunchtime to NV Private Equity. On your behalf, I'd like to thank Luke very much for that really insightful quick trot through. This will be recorded, so obviously you can mug up on this later at your own leisure. And we also have another Harbourvest Global Private Equity who will be presenting at the same time tomorrow as part of our mini series on private equity. Is it right for a rebound? So thank you so much, and I'll hopefully see you tomorrow.
Thank you.